Coming up on Market to Market, the rally continues on Wall Street, accompanied by a concurrent recovery on Main Street. Soaring meat prices prompt one lawmaker to seek a federal ban on packer ownership of livestock. And the Iowa legislature approves a bill making it a crime to enter farming operations surreptitiously. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, March 2 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Wall Street traded higher again this week on a flurry of positive reports on the U.S. economy. According to the Labor Department, weekly applications for initial unemployment benefits dipped last week to a seasonally adjusted 351,000, their lowest level in 4 years. Separately, the Commerce Department reports consumer spending increased 0.2% in January, but orders for big-ticket durable goods fell 4% in the first month of 2012. That's their largest decline in 3 years. Equity traders took the mixed data in stride as the Dow Jones Industrials closed above 13,000 Tuesday for the first time since 2008, while the tech-heavy NASDAQ settled at its highest level in 12 years. Optimism for an economic comeback isn't limited to Wall Street, and this week a key barometer of the rural economy revealed simultaneous expansion on Main Street. An economist who oversees a monthly survey of 9 predominantly Midwestern states says the recovery that began in agriculture now is rippling into more sectors of the rural economy. Creighton University's Mid-America Business Conditions Index rose 2.5 points in February to 58.4. Any reading above 50 indicates economic expansion.
That index was up strong number for the month of February. And so what we saw is what was in the agriculture and energy sector now is much broader.
Data for the index is compiled from a monthly survey of supply managers and executives in Arkansas, Iowa, Kansas, Minnesota, Missouri, Nebraska, North Dakota, Oklahoma, and South Dakota.
All in all, it was a very good report. The national numbers coming out are going to tell much the same story. We're going to see the unemployment rate move down in the months ahead, and we're going to see employment growth moving up in the months ahead, and that's for the Mid-America region, that's for the U.S. economy. The only potential fly in the ointment, what we could see would be something in oil prices moving up between $120 and $130 a barrel. That would put a dent in the growth.
Crude oil prices began 2012 in the neighborhood of $100 per barrel, but the world's most heavily traded commodity has climbed considerably on concerns that global supplies could be reduced as the West confronts Iran over its nuclear program. Benchmark crude declined by more than $2 per barrel Friday after reports of an explosion at a Saudi Arabian pipeline proved to be false. Gasoline prices, however, rose again Friday for the 24th consecutive day as the national average hit $3.74 per gallon. That's up nearly 50 cents since January. Energy, of course, is a major input cost for America's farmers and ranchers, and it occupies a prominent position on accounting ledgers, both as fuel and fertilizer. But many livestock producers say their bottom lines also are heavily influenced by vertically integrated companies which own multiple steps of the production process. And this week, a bipartisan group of lawmakers introduced legislation designed to level the playing field. A group of senators introduced a bill this week that would ban most meat packers from owning or feeding livestock intended for slaughter. Democratic Senator Kent Conrad and Republican Senator Chuck Grassley are the lead co-sponsors of the measure.
I propose the packer bill banning packers from owning livestock because I want to protect the family farmer, and packers owning livestock is very unfair to the independent producer.
The bill excludes single pack entities and packers that are too small to participate in the Agriculture Department's mandatory price reporting program. It also exempts farmer cooperatives where members own, feed, or control the livestock themselves. Grassley said the CEO of a major slaughterhouse once told a group of farmers, "Packers own livestock so that when prices are high, they can butcher their own animals, and when prices are low, they can buy them from farmers." Grassley describes the 2012 Farm Bill as a great opportunity to deal with vertical integration before it's too late. He says outlawing packer ownership of livestock makes sure the marketplace works for the farmer just as much as it does for the slaughterhouse. According to senators backing the bill, farmers and ranchers have long expressed concern that allowing meat packers to own the animals they slaughter reduces competition for livestock raised by independent cattle producers. They say this market manipulation, along with increased concentration, has made it difficult for many independent producers to compete.
I think all segments of the animal agriculture will be helped by my legislation. But most importantly, it's going to send a clear signal to packers of the inordinate impact that they have on the free market system.
The Senate passed versions of the packer ban legislation in both the 2002 and 2008 farm bills. However, each time, the provision was removed in conference committees. The ability of a single company to control the entire process has revolutionized livestock production in America. Virtually all of U.S. poultry is produced by vertically integrated companies, and the vast majority of the nation's hogs are raised on contract for companies that sometimes own the process from semen to cellophane. But some producers say other, more insidious dangers also threaten their livelihoods. And this week, in the nation's top pork-producing state, lawmakers approved legislation making it a crime to enter a farming operation surreptitiously. Paul Yeager explains.
A bill making it illegal to apply for a job in a farming operation under false pretenses is close to becoming law in one of the nation's largest livestock and commodity production states. The measure passed the Iowa legislature this week and now is awaiting the governor's signature.
Our agriculture community needs some safe havens. We want to make sure that we have a safe food source. And with this bill, we want to make sure that everybody that is involved in our livestock facilities and also working within those livestock facilities are forthright and want to make sure that our livestock is kept safe.
Representative Annette Sweeney, a farmer herself, wrote the bill, adding there are cases in Iowa where activists have lied on job applications in an attempt to get hired at livestock production facilities. The new law makes that a serious misdemeanor. A controversial measure was removed from the bill, making it illegal to surreptitiously document animal abuse. But opponents want Iowa Governor Terry Branstad, who is expected to sign the bill, to veto the measure over concerns of stopping whistleblowers who secretly record inhumane treatment of animals.
This is flawed and misdirected legislation that sets a very dangerous precedent nationwide by throwing shut the doors to industrial factory farms and allowing animal abuse, environmental violations, and food contamination issues to flourish, unchecked, undetected, and unaddressed.
The group Mercy for Animals held a protest this week in the shadow of Iowa's capital. 30 protesters, who were symbolically gagged and blindfolded, represented the California-based organization.
Mercy for Animals took their hidden cameras into a New York dairy, and what they found will shock you.
Mercy for Animals says their undercover investigations in factory farms in Iowa and around the country have led to criminal charges for animal cruelty as well as landmark legislation, rescues of abused and neglected animals, and policy changes in major corporations.
Mercy for Animals undercover investigators serve as the eyes and ears of the American public, who are kept largely in the dark about how animals are treated before they reach our plates. As a civilized society, it is our moral obligation to protect these animals from needless cruelty and suffering.
Vandahana Bala, MFA's general counsel, said Americans want more transparency in their food production system.
If factory farmers truly cared about animal welfare, they would be providing incentives to whistleblowers. They would be installing cameras in their facilities, and they would be working to strengthen the animal protection laws in the state of Iowa.
I really think it's an attempt to protect agriculture but not have any subversive acts by groups trying to bring down an industry.
Iowa State Senator Joe Sang, a veterinarian who helped shepherd the bill through the legislature, is concerned about the potential for health risks. He said he's interested in keeping unauthorized activists out, but not prohibiting someone from working legitimately on site.
Maybe corporations or even small farmers They have their life savings invested into their facilities. Of utmost importance to these people are the fact that they have invested money as far as keeping birds out of there if they have a poultry house, keeping vermin such as mice, rats, even cockroaches or anything from coming in there and tracking in diseases from the outside.
Iowa is the first state to pass such a law. Similar legislation is being considered in as many as 13 states, including Utah, Florida, and New York. For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
Weather forecast this week calling for dry conditions to continue in the southern plains push wheat prices higher. For the week, May wheat gained 33 cents, while the May corn contract moved more than a dime higher. Soybean prices exceeded $13 per bushel Monday for the first time in 5 months, and the May contract settled Friday with a weekly gain of 46 cents, while nearby meal prices advanced by nearly $23 per ton. In the softs, cotton prices headed south, with the May contract giving up $1.92 per hundred. And in the dairy market, April Class 3 milk futures gained 29 cents, while the May contract moved 3 cents lower. In livestock, April, the fat cattle contract gained 45 cents. The calf market, feeder cattle rallied more than $1, and the April lean hog contract advanced by 70 cents. In the currency markets, the euro lost more than 200 basis points against the dollar. Crude oil declined $3 per barrel. COMEX gold declined $66 per ounce. And the Goldman Sachs Commodity Index lost more than 10 points to settle at 703 3/4. And here now to lend us his insight on these and other trends with regular market analyst Don Roose. Don, good to have you with us.
Thank you.
Another eventful week in commodities. Another week kind of hinging on what's happening with the weather, and in this case it was U.S. weather, and also some informant numbers out this week on the South American crop, maybe a little bit smaller than what we'd anticipated. So a lot of issues out there, a lot of unknowns as we approach 2012. We do know what our 2011 production is for the most part. You got a USDA supply demand report coming out. It's going to update the global situation in here in the U.S., but as we sit here tonight, Don, and we look at where this market's been, we look at all these factors that impact us: Iran, Syria, Israel, crude oil, the euro, what's happening in Greece. On it goes and on it goes. People try to make decisions. We passed through March 1. We sold a little bit of corn. I still have this sense there's a lot of corn in the bin out there. That's going to be a factor. Let's start with the grains, and let's start with the wheat market first. That was a big move this week for wheat.
Yeah, when you look at the wheat market, it's moved up to some tough resistance again, Mark. And, the problem with the wheat overall is the stocks-to-use ratio is large, probably in that area of 40-45% stocks-to-use ratio. So there's no shortage of wheat. Really what wheat's doing is just following the corn and the soybean market higher for the short term.
Trying to maintain some acres or do something here.
Yeah, I think it's it's really just trying to keep competitive from an overall world balance table. And, we're feeding a large amount of wheat around the world, but, there's not anything that signals that we're really moving into anything but still a supply bear market so far.
All right. And the situation in Europe, we'll know about what the impact of that was down the road. Was it significant in terms of the wheat crop?
Well, I think, it was. There's no doubt we lost some percentage of the wheat crop in Europe, not only in Europe, but also in Ukraine and Russia. So, the Black Sea and, the cold weather that we have really has been a big influence because it's slowed down the shipments of wheat out of that area.
All right. We're making any sales here, Don, on wheat?
Well, we think when you look at the wheat market on Chicago, new crop, as you move close to the $7 mark, which we're starting to get ever so close to, those are opportunities to catch up on some sales. And the same thing with hard red winter wheat, July up as you approach $7.50. Those are good long-term targets, and probably going to have some North America weather problems to push past that area.
All right. Weather's a big issue with corn too, and like you say, corn's king. It's driving everything else for the most part. The beans seem to have some life in them right now. So let's talk about corn. Informant numbers out of South America on the corn crop, a little bit smaller, but not that much. The Argentine deal was kind of anticipated. Anything else is going to impact these old crop prices?
Well, I think when you look at the old price on corn, really what's happened is, the producer is just sitting very tight. He's really not an aggressive seller at all. And, I think the other thing that really is going to influence it when we move into probably the big issue that I think we have to be very concerned with is the March 30th stocks and all positions report, because we've had a very mild winter, and we think that the chance for a negative stocks in all positions March 30th is probably something that you have to be careful of. So, for right now, we're riding the coattails of tight farmer selling and the South America crop that is smaller, and that's been pushing us up to the upside. And also, we've had a terrific amount of fund buying, a new month this last week.
What's driving that, Don? Why are the funds all of a sudden showing back up in corn?
Well, I think when you look at the funds, really what they look for is a market that has some potential fundamentally. And I think when you look at the stocks to use ratio that you have on old crop, 800 million carry out, it could be larger than that, but that's really close to pipeline minimum. So, you see fund buying on that. And the same thing on the soybean market on new crop, we've had some fund buying there. So interest rates this low, Mark, you certainly have commodity funds looking for alternative investments.
All right. Talked to a lot of producers all over the country in the last couple of months. Everybody wants to hold tight because I think it's going to be a tight transition again from old crop to new crop come July, August. Do you agree with that? We're going to see that again? We've had that happen now for the 2 previous years.
Well, you have to be careful because you're exactly right. We've had 2 years with back-to-back problems during the summer, and that's really, what has propelled the market higher. But, to have 3 years of crop problems is really, quite unusual. And, I think what we're looking forward to is probably a more normal growing season. And I think you have to be careful of the yields don't jump up to, a bigger yield than what we have had experienced in the past, and therefore, our stocks may not be as tight as some of these southern states start to put corn in the pipeline earlier.
We were talking about 95 million acres of corn being planted a month ago. Now that's kind of been dialed back to around 94 million, maybe an increase in bean acres, but that acres number is going to be pretty significant at the end of March too.
Yeah, that's going to be a big number, and probably right behind that, of course, is going to be the weather, and do we actually plant those acres? But we're all on pins and needles on the acres, but the acres are certainly there, and we think we're going to get acres on both corn and probably soybeans.
Okay, so 94 million plus on the corn and 75 million plus on the beans.
Yeah, we think so. We think that's a high probability if the weather is right.
All right. Since we've never had 3 bad years in a row, and all the old timers like you and I are repeating this, if that's indeed the case, should we be selling new crop corn right now?
Well, new crop corn has a lot of resistance right at $5.70. A weather scare will probably push you up close to $6, which is going to be a tough area to push through. But when you look at stocks to use ratios that have a chance to double next year, and if you have a yield that jumps up 1 standard deviation and goes into like 172, 173, ending stocks could go over 2 billion bushels. With that, you pushed back down lower, closer to 5. So, these look like attractive areas unless things change.
All right. Let's talk about the soybeans and talk about this new sheen that the soybean market seems to have of late. And again, you mentioned open interest is jumping up on both corn and soybeans. Certainly there's Chinese demand. It looks like it's going to be strong again this year.
Yeah, really what's driving the market is, like you alluded to, the Chinese demand is underneath the market. But, their buying pace is down 21% from last year, so it's slower than you think. But, the real driver, much like has been the driver around the world the last 2 years, has been a smaller crop in South America and the uncertainty whether we're going to have the acres. So, that's really the driving force. And, the spreads on new crop soybeans, you got November inverted over July 13th. So it's telling you we're really pushing the buttons pretty hard to get the acres out here.
That's right. And you think it's going to work? You think it'll be 75 million plus here in the U.S.?
Yeah, we think it will be between 75 and 77 million, actually, because we're going to have 9 to 10 million acres coming out of prevent plant and 1 million out of CRP.
Yeah, so and those is a logical place a lot of times especially those acres coming out of CRP, first years but go to soybeans. So you got some good points there, Don. So making any sales? Are we jumping on this new crop thing?
Well, new crop, it's trying to get close to $13 and it's really close. So, if you look at it, we think that 13 to 13.50 is a real opportunity to sell. We're 45 cents at that level over the insurance rate, which was set at 12.55. So we think that does present some selling opportunities, and probably sooner rather than later. Oil and soybean meal turned down technically on our indicators, so we think that's maybe the start of things starting to get a little bit shaky.
Cash basis on soybeans, we had a strong cash demand on corn. Is it as strong on beans?
No, we've got a bigger carry on old crop soybeans, and we also, the basis levels on soybeans are more relaxed, than corn, partly because we have 275 million carry out on soybeans, which is actually pretty large. So, the soybeans really has been artificially supported by the problems that we have in South America.
All right, let's talk livestock for a minute. $1.30 down in Texas, $2.05 in the beef, up in the Midwest. I mean, these are some pretty good times to be in the cattle business.
Yeah, it has been, and making up for some lost times from before. But when you look at the cattle, the supply-demand balance table on the cattle market's positive. There's no doubt about it. Really, the driving factor is going to be, will the consumer pay up for beef? Beef is getting close to $200. $201 was the all-time high in beef in 2003 of October. So now we're going to have to move the beef as we move up. We think next week that the beef starts to turn a little bit toppy, and that probably is going to start to spell some problems. All
right, maybe a little bit of a pullback, but decent prices for the balance of the year?
Yeah, I mean, we should have decent prices. There's no doubt that the fundamentals are there to push April cattle up close to that 135 mark. But, it's going to be a market that if demand slips at all, you're going to have sharp setbacks, and then we'll see if we can drive back up. But you got, big numbers out in these deferred cattle. Next year, 136 on cattle. Those are lofty levels by historical standards.
Absolutely. And the calf market's going to remain strong as well because they're not there.
Yeah, I mean, the numbers just aren't there on cattle. You're exactly right. So the cow-calf person, he's in the driver's seat, and that's the job of the market, is to retain heifers. So that's the final phase of the bull market, is that retention, and supplies get even tighter.
There you go. Let's talk about the hog market. We did a better job producing pigs in 2011 than I think a lot of people thought. There seems to be some bigger numbers out there. Prices have been strong, but this seems so export sensitive anymore, the pork business.
Well, the pork business is export sensitive, and it's, the exports have been on fire. We're exporting this next year probably 24% of our pork versus 11% on the beef. So, the hog market, the big plus on the hog market is the beef supplies next year probably going to be down 4%. Poultry, or broilers, are probably going to be down 3%. Pork's going to be up 2 to 3%, and it's going to pick up the slack, and it's going to have to follow the cattle higher. And we've got some lofty numbers already built in, and we'll see if it can hold or not.
It's very volatile. Your thoughts on the oil market as we close out here tonight?
Well, we know that if the oil market surpasses 110, between 110 and 120, it really starts to slow the economy down. So, I think in election year, there's going to be a lot of talk to try and push the oil price down. We know that we've got a lot of premium built in because of the Iranian situation. We know we have excess gas supplies right now. And, we think it's a market that is lofty up at 110 and technically is probably due for a setback.
A big setback in gold this week. What are your thoughts on that?
Well, we did. We had a big outside day down on gold and silver. And I think what it really says is how volatile these markets really are, all the markets, and they're going to stay that way. And so risk management is probably key. But, the gold market, it just really struggles when it has to perform over $118.
I've got 5 seconds. Your thoughts on the dollar?
The dollar, we think it's the best of the worst, and we think that the dollar is going to, continue to try and move higher.
All right. As usual, Don Roose, some great insights. We appreciate you joining us. That'll wrap up this edition of Market to Market. But you'll find expanded market analysis and streaming video of our program, as well as links to our Twitter feed and our Facebook page. It's all free at our website. Now, we want to remind you that Market to Market may be airing in some different time slots in the days ahead due to PBS fundraising activities. So if you value programs like Market to Market, please consider phoning in a pledge and investing in a service providing you with accurate information and timely market analysis each week and every week throughout the year. And be sure to join us again next week when we'll examine the Agriculture Department's new Conservation Reserve Program. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.